And welcome to Dr. Frank's Finance World. I'm Dr. Frank, the bank, where I try to teach you something about finance so that you can make a little bit more money for yourself long term. What we're talking about today is discounted cash flow. It's another process or part of the step, really, of looking at what a company is worth and looking at their numbers. The discounted cash flow is pretty common in the investment world out there, at least at the higher levels in Wall Street and so forth out there. So I thought I'd break down the process and let you be able to calculate it for yourself. Be sure to subscribe and get notifications. Look for links at the end of the video and check out our books in the bookstore we have at drfranksfinanceworld.com. So the basic idea is to look at all the possible cash flows that firms will throw off to its shareholders and then discount them back to see what they're worth today. We will discuss time value of money ultimately in this whole video series out here. But the basic idea of time value of money is essentially you have a timeline. Hold on, so we get this started. You have a timeline here where you have cash flows along the way, and you want to bring them back to today to see what they're worth based on the risk that you're taking to bring them back through time. And you figure out this I is what we're going to look at today, the required rate of return. But by the time you get further out, you may be bringing it back for a long period of time. When we get to bonds, in this case, when we're looking at it for 5 years, bringing it back. But at any rate, we're going to bring all those back through time and figure out what they're worth today. So here's the income statement that we had last time. We did this in the previous video where we talked about the numbers through 2012 and then we grew them for 2013 and beyond. And we took the cost of goods sold and so forth, and we finally came down to a operating margin, and then finally the net income that you would have for each. You see, it's $43, billion in this case for this company, and you took what the net income was and then to put it in a per share basis, and that's what these numbers are worth in here. These are pretty close to what you would actually consider the cash flows. There's a couple of corrections we have to make where we have to add back depreciation, because when you look through an income statement, the only thing you don't write a check for is you don't write a check for depreciation. You write it for interest expense and for taxes and all the rest, but you don't. So that's a non-cash item, cash flow item flowing out. So we add that back. And then ultimately firms invest in projects. And since we're looking at free cash flow, we have to look at money that's already spent. So that's what that's all about. All right, so here, when you brought it back through time, you're looking at the depreciation as well. These are the depreciation numbers we had previously, and you're going to add these back to the net incomes over there. And these are the capital expenditures. This firm is spending a pretty consistent, I think it's 2.1%, something like that, of their revenue on capital expenditures for new operations and goods and all that kind of stuff. So this is going to reduce the net income available, the cash flow out there. And when it's all said and done, you look at numbers like this. I think I put the wrong number in there, but you look at the free cash flow. If you took, for instance, up here and you took the net income, it was about 43 billion, and you added the 3.6 billion for depreciation, you end up with 46.8. When you subtracted the capital expenditures, you end up with numbers that look like this. And then you take these numbers a per share basis. I divided the wrong one. It's about $40 too. And each of these become cash flows that we're going to have to bring back through time at the required rate of return. But that's where we get all the numbers to lead up to that. So how do you discount it back? Well, in the world of finance, we also have a formula for that. It's called the capital asset pricing model. And you bring things back through time. This is sort of the required rate of return for the firm. Everybody, we feel like, should get a risk-free rate of return for anything that they invest. If they're not taking risk, you got to get something for not spending your money right away, right? And then you need to adjust the riskiness of the company, which is what beta is all about, by the return of the market versus the risk-free. Essentially, this is something that's been called a market risk premium out there, and it represents the extra you should get for being in stock. So an investment should make you something for risk-free returns, and then an additional, if you will, for taking the risk of being in stock. So you can look up beta. If you go back to the data stuff that we put on here, every stock will have a beta inside of Yahoo Finance, for instance, or Finviz or whatever. But we're going to have to figure out what this formula looks like, because this right here, this is the magical number that, if we go back a slide, we're going to actually divide each of the cash flows by. So All right, so there is a risk-free rate of return. Many times people use a 10-year treasury. You're trying to get a longer-term rate. While this says 2.69 currently in the late fall of 2022, that's more like 3.5%, 3.6 or so. But you will take the risk-free and you will add to it some type of market premium, but the market premium, as we saw from the previous slide, is the difference between this two. So what was in parentheses as market risk premium is this. So we multiply the beta by the market risk premium and add it back to the risk-free rate. This is the magical number that we get. So each of those cash flows that we had out there will be divided by 1.0896 to however period of time we're bringing it back along, however long that is bringing it back through time. So this really is kind of the first step of valuation, is to bring back what those cash flows are actually worth. And that's how you go about doing it, is figuring out the cash flows first, and then of course what the risk is you're taking to get there. So, all right, there's a good book out here, Discounted Cash Flow, A Theory of Valuation by Lutz here and Andreas. If you want to check that out, it's in our book feed inside of drfranksfinanceworld.com. What does research say about all of this? Well, we've actually pulled that up over here. Stand by. Reconciling value estimates for the DCF model and residual income. So this is kind of getting at a couple of things here. One is there's more than one different type of model. DCF is very common out there. It's fairly straightforward and somewhat easy to understand, but sometimes you get differences between models. And so both models are derived from the same underlying assumptions. The price of those present value of the cash flows discounted by that cost of equity should, in theory, yield the same price. But it didn't always. And so they review research looking at, we identify how prior researchers applied inconsistent assumptions to the two models and show how these seemingly, this is what I thought was in, the seemingly small errors cause surprisingly large differences in the value estimates. That's exactly right. And it's why you can have somebody say, hey, pick a stock, Home Depot, Tesla, whatever, and say, hey, this stock is worth $300, and another analyst will say it's worth $600, because by the time you extrapolate small differences, you get a huge difference sometimes in the prices, which is kind of a beef that people have with this model, the inconsistency of that and the variation that it can cause. But at any rate, we have to live with all the nuances, right? So that was just an interesting one. I want you to think about why your numbers could come up so differently than somebody else's. And in the end, my opinion is, at least what I tell my students is, your numbers are as legit as anybody else's. If you've looked at the company, you've looked at the products, you've looked at the growth rates, you've made your estimates, and you've brought it back through time, yours is as good as anybody else. At the conclusion of part 2, I'm going to show you how you use this information to decide whether this stock or this company is fairly valued or not. So don't forget to send emails and comments or suggestions, please, or anything you have about Ask Dr. Frank. We're going to start building that through time to Dr. Frank's Finance World. It's actually going to be at jbawealth.com. But anyway, Discounted Cash Flow part 2 is next. Appreciate you hanging. Have a nice day. See ya. Bye-bye.